You may have been hearing recently that it's easier to outperform the market than it once was. Well, it's an exciting prospect, but the reality is nuanced. It may seem tempting to try and beat the market with your retirement funds, especially in light of the recent Morningstar report. It's important also to exercise some caution. The report indicates that in the first half of 2023, 57% of actively managed funds and ETFs outperformed their benchmarks, with some specific categories faring exceptionally well. This percentage appears much higher than historical averages, prompting enthusiasm among investors. However, it's important to remember that the market outperformance isn't a one-sided equation. If one set of active managers is beating the market, another set must be underperforming. Furthermore, once you consider transaction costs, the collective average return of active managers is likely to be below the market return. This perspective aligns with a foundational article from the 1991 issue of the Financial Analyst Journal by William Sharpe, a Nobel laureate in economics. Sharpe argued that active management, on average, would underperform market indexes supported purely by basic arithmetic. Some argued that the increasing market share of index funds has made the market less efficient and easier to beat, or that today's managers are more sophisticated. Still, Sharpe's reasoning stands. Beating the market is a zero-sum game before considering transaction costs, and it becomes a negative-sum game afterward. For those still convinced they can outperform the market, an approach suggested years ago by the late Henry Brown may be worth considering. Brown advised investors to maintain two separate portfolios: a permanent portfolio consisting mainly of index funds and a speculative portfolio where they could try to beat the market. This approach acknowledges both the statistical wisdom of Sharpe's argument and the psychological need to believe you're above average. It allows for some risk-taking without jeopardizing long-term financial security. While there may be years when your speculative portfolio outperforms the permanent one, the likelihood is that over the long term, a more conservative approach will yield better results. Remember to always consult your financial advisor before making any financial decisions. More importantly, remember to hedge. Each time you increase your risk, increase your hedge with gold. Diversifying investment portfolio with gold or other precious metals can offer several potential benefits. Gold has traditionally been seen as a hedge against inflation. When the value of money decreases, the relative value of gold often moves up. As a result, investors often turn to gold to preserve their purchasing power of their wealth. Gold is often less volatile than individual stocks or even stock indexes. Including it in your portfolio can help you achieve a smoother trajectory of returns over time. More importantly, gold is a physical asset, which can be comforting for investors who are wary of financial assets that only exist in digital or paper form. If you want to invest in gold now, or you simply want to talk to someone rather than watch a bunch of videos or read an article or any of that, just call us. Our phone number is 877-646-5347. It's a no-pressure consultation. All we do is answer your questions, or you can check out our website at noblegoldinvestments.com and download our free guides.